So today we're going to be talking a bit about an introduction to financial literacy specific to MD PhDs. And the reason why we wanted to organize this talk is because the previous financial advisor who used to do this talk has now retired. So right now there's nobody who is doing this talk for you. But the second reason is that when I gave you guys your lecture on financial literacy as a group, as the whole medical class, there were a couple of questions from the MD PhD students about their finances, especially when they take like a gap year and things like that. So for this lecture, we're going to be focused on MD PhDs. And because I'm not an MD PhD myself, but I want to make sure you guys get the full info, I've invited Dr. Ayan Dey, who is an MD PhD himself. And he's already graduated from medical school and is currently a resident. So I'll be introducing him in this particular section. All right, so Ayan graduated from the MD PhD pretty recently, so he has a lot of good knowledge for you about what kind of financial things you should consider. And as I mentioned earlier, he's a PGY1 in psych. I try to make sure that a lot of the guest lectures do come from either like diverse backgrounds themselves. So Ayan does come from a low socioeconomic status himself, and he's self-taught. So what does Dr. Ayan Dey invest in? He invests in index funds, ETFs, individual stocks, Bitcoin, as well as real estate. So he has a condo as well as a house in the East York area that he acquired after the Karms match. I just wanted to make sure that the conflicts of interest slide here. So there's no conflicts of interest to disclose, and all the information presented are those of the presenter. And for some of you who might not be MD PhDs or your partners of MD PhDs that are joining this talk, some of the advice provided here might not necessarily apply to a general MD program student, as they're quite tailored for that extra training time that MD PhDs do have. So some of the things we're going to talk about today: why should we invest as MD PhD students? Some of the steps that you should take when it comes to investing terminology, renting versus owning, investing with your line of credit, and some resources. Finally, the Q&A section. So feel free to send some questions via the chat, and that way Ayan and myself will help answer those questions at the end. All right, so there's just going to be some polls coming up, and this is just getting to know you. So the first audience poll, and Sachin's going to pull it up onto the screen. Where do you get most of your practice management or personal finance education from? You can pick more than one. It looks like the majority of you guys, this is, you've gotten a lot of your information from family members. Okay. Some of you guys get it from financial advisors and blogs and websites. Great. All right, so we'll just stop sharing this poll and move on to the next poll. All right, so as you can see, a lot of you guys here kind of have investments already, managed by either somebody else, but there's maybe like two people or two or three people who kind of does their own thing too. All right, so I'll stop share. And because we're going to be talking about some investments today and about terminology of stocks and whatnot, in this poll, it's to talk about what do you invest in. All right, so it looks like a lot of you guys haven't started investing yet, but there are still some of you who do invest in individual stocks, real estate, and in terms of mutual funds and ETFs. And then someone in the chat says anyone else for other because they invest with a robo-advisor. So most robo-advisors, it would be classified under, I guess, ETF category, because that tends to be what, I guess it'll be ETF/bonds, depending on the type of investment you have. So yeah, I guess that would be part of others if it's not identified here. All right, no problem, thank you. All right, so now I'm going to pass it on to Ayan to talk about why should you invest as an MD PhD student. So Ayan, take it away.
Hey guys, I'm happy to see the turnout here. So my name is Ayan. I graduated not too long ago, and I actually started investing when I was an undergrad. So it's been almost like 10 years since I started investing. And it was really a lot of my inspiration came from reading this book called Rich Dad, Poor Dad, because I really identified with that. But I had no idea what investing was and why I should invest. I remember I was like working as like a security guard somewhere. And I'm like, I need to make better use of my time. There's a lot of downtime when you're a security guard. So I'm like, okay, I'm going to learn how to invest. So that's why I spent my time learning how to invest while I'm doing this job, because it was that boring. So that, and then flash forward like almost more than a decade, and here I am now. So there's a lot of reasons for why you guys should be at least starting to think about investing early on, especially for those in their earlier years of the MD PhD program. One, compared to, and there's a lot of differences from the regular medical school class. One of which is we actually do have some income coming in. It's not a dramatic amount, but we do have like a base stipend, and it's non-taxable. And then you also have the opportunity to grow that cash flow through research scholarships that are often added on top of our base stipend. And then during our graduate years, we also, and I guess during med school too, you have a little bit of flexibility in terms of having some side hustle. So whether that could be like TAing on the side, summer jobs, etc. So income is a component that really separates us from the regular med school class. Next is we're really in it for the long haul. Like the amount of time that we're in the MD PhD program is like between 7 and 9 years, like for those starting off. And then you add 2 to 5 years of residency. So that's like an opportunity cost of between 9 to 14 years. That's a lot of time to miss out on investing and at least having some money in the market. So the more time you spend in this market, I guess learning about investing, you really develop an appreciation for how time is money, and doing this like 14 years, up to 14 years of additional schooling beyond everyone else is really a massive opportunity cost. And also during this time, life goes on. Even maybe when we're starting off, we're not married, we don't have any kids, etc. But by the time you finish residency, a lot of us will be married and we may have kids. And if you're still like not in the market or not investing, it's really the opportunity cost keeps on growing. And then speaking of things that are growing, there's also the real estate market. You're probably hearing a lot about this in the media, really for like years now, but particularly now because prices have gone nuts. So the price of real estate keeps on going up, and the average price of a house now in the GTA is $1 million. And I don't know if a lot of you guys know this, but once you get beyond $1 million, you need at least, according to Ontario laws, you need at least a 20% down payment. And coming up with a 20% down payment, even on a physician salary, is very hard to do. Because that's like post-tax savings. So you need 200,000 to even get into the markets for a house. And that money doesn't really just pop out of nowhere. It takes time to develop that. So that's another reason for to at least start thinking about investing early. And lastly, also relating to the opportunity cost. Right now, we have a massive opportunity. Interest rates are historic lows. I don't think it's very unlikely for it to go ever lower than this. Although we've heard like reports in like Europe where you see like negative interest rates, etc. But barring a bizarre situation like that, interest rates are like extremely low right now, and inflation is increasing. You may have also heard about that on the news. And the reason I bring up inflation is that the cost of doing nothing keeps on growing as well. So you may feel that it's really safe to keep it on in just a savings account, but there is a growing cost of doing nothing because of inflation. So to put things into perspective, so when I started medical school or the MD PhD program, it was like say 2012, around then. So if hypothetically I just put $5,000 into my TFSA and put it into like an index fund, like VFV. So this is the Vanguard S&P 500, and just put that $5,000 in at the beginning, and then I contributed just $200 monthly over the duration of my MD PhD, over that decade. I would actually end up with $56,000 by the end of it, just based on that growth. And I know everyone's really scared of crashes. Like, oh yeah, the world is ending, the crashes. So look at COVID. This is what the impact of COVID was when everyone thought the world was ending. It's really a blip in the grand scheme of things. So this is why it's important to keep an eye on the big picture. And that's why seasoned investors don't panic when things go awry, right? They don't panic. They actually see it as an opportunity. And at least for me, when COVID happened, I thought, and I saw the impact on the market, I was like, this is money, right? And I just went nuts on investing at that time. And that's when I bought my house and pretty much saw it as an opportunity. And that's why I want to inspire you guys to see as well, when the opportunity strikes, to at least start considering getting in. So now suppose if you didn't contribute $200 a month, because I know as MD PhDs and as medical students, you may not have an extra $200 at the end of the month. What if you just put $5,000 in at the beginning of your MD PhD? What would that be? So again, if I just put $5,000 in when I started, it would have been 20,000. And I literally put $5,000 in and did nothing, right? Nothing, no contributions. I would have made 4 times in the duration of my MD PhD. And although maybe 20,000 may not seem like a lot in terms of a grand scheme of a down payment, when you contribute regularly, and over time, that really grows. So in terms of how to start getting investing for those who don't do any investing on your own or have someone else handle that. So the first thing to really do is establish a risk tolerance, right? Like, what are you willing to tolerate, right? Like, do you know yourself? Can you sleep at night knowing that the stock market is crashing, that you may be losing a few thousand overnight, and that doesn't bother you? That doesn't bother your day to day. And you can just push it out of mind, right? And just knowing that risk tolerance, and that also comes down to cash flow as well. How much can you spare? You shouldn't really invest more than you're willing to lose, and everyone's willing to lose a different amount. And then also what type of trader you want to be. Do you want to be an active trader where you're looking in every day, maybe sometimes multiple times a day, or maybe once a week, right? Or be a more passive investor where you just put that money in at the beginning and just forget about it, or you put that money into 1 or 2 funds and just contribute monthly or quarterly. So that's that's like the first step. What are you willing to tolerate? Next, if you don't already have one, open up a TFSA account. And I say TFSA, not an RSP, because it's tax-free and you can contribute and withdraw freely without any penalty, right? Up to your limit, of course, right? And then I think your limit grows by like $6,000 a year. So, and the reason I say not RSP is because if you put money into your RSP and then you withdraw it, there can be a tax penalty with that. But with the TFSA, that doesn't happen. So if you need it for like a major expense, you can take that money out of your TFSA and then recontribute that back in the next year. Up to your limit. Other things to consider is something like commission. If you're going to be trading very frequently, right, you need to be considering how much you're willing to pay for commission. So sometimes, and every bank has different commission rates. So for RBC, for example, the commission rate is $9.99 a trade. But for something like Questrade, which is another platform for trading, that's like $4.95 a trade. Unless you're making massive trades, then it can go up to $9.95 or even higher. And then there's also Wealthsimple, which is free, but free also comes at a cost. You need to, Wealthsimple is not as transparent with their cost, but with Wealthsimple, it's more expensive to trade in US stocks because they charge a bigger margin in terms of the foreign exchange fees. So you actually end up paying a lot more for your US stocks with Wealthsimple. And they also charge some management fees in the background, which they're not very transparent about. So although it's free, there are costs. Next, you want to start contributing, right? If you've never invested before, you want to start with a small amount, right? Like 1,000 to 5,000, right? And when I started when I was an undergrad, all right? I had like very little money. So I was like, okay, $2,000 is a lot for me, but that's my tuition. I'm spending all this money learning about towards this degree or whatever, right? So I thought of my initial investment, my 2000 or whatever, as being my tuition to learn investing. And the reason to learn investing early is that everyone makes mistakes, right? It's easier to tolerate these mistakes when you're much younger, right? And you have a lot less, like you can own, like $2,000 right now in the context of our life, especially as physicians, is not going to be a big deal, right? And when you make mistakes with $1,000 or $2,000, even though it seems like a big deal now, in the grand scheme of your life, it's not a big deal. But making those mistakes when you're a seasoned staff and you're playing with maybe $10,000 or $20,000 because you have that extra funds is going to have a more dramatic impact on your life, especially when you have more responsibilities. Like you might have also a mortgage, you may have kids, etc. It's so much easier to get away with mistakes when you're younger, right? Just because in the grand scheme of our lives, especially as physicians, it's not going to make that much of a difference. So consider it like your tuition at the beginning, like to learn investing. At least that's how I saw it. And then educate yourself on how trading works. I can only go into so much during this lecture, but like, for example, knowing what the difference is between an individual stock versus what an ETF is versus what a mutual fund is. And then there's something called options, which is really advanced. And I wouldn't recommend that for anyone that's getting started off. I still haven't really wrapped my head around options, and I don't really dabble in options very much. Or rather, I haven't been successful in dabbling in options. And then finally, invest, like find out how much you want to invest that, and then contribute monthly if you want to and if you can. So next, I'll start off with some investing terminology. So like really the basics. You might hear a lot about index funds and ETFs, right? So I really will focus on that. An ETF or index fund is essentially a collection of individual stocks, sort of like a meta-analysis, if you got to put it in like scientific terms. It's like a meta-analysis or the equivalent of a meta-analysis, but in terms of stocks. All right, and it's basically a library of individual stocks for a given sector or the entire market as a whole. So you could, for example, an example of an ETF will be the Vanguard, the one that I mentioned before, the VFB. And that is a collection of the biggest companies in the market. But as you will see, that it is skewed towards certain companies and skewed towards tech, right? So you have Apple, Microsoft, Amazon, Facebook, Alphabet, which is Google, all these companies, and they make up the biggest holdings in the Vanguard. And that's why when tech suffers, the whole market really suffers. But the way you can also diversify is getting even a larger ETF, which looks at the global market, or you can focus on specific sectors where you get an ETF for, like, for example, clean energy. You get an ETF for banks. You get an ETF for so the Chinese market or Chinese tech, right? Like whatever industry that you think you're comfortable with or that you think will grow, you can get an ETF with, and you can find that. So the pros of an ETF is that they grow a little bit more gradually because of the diversification. It limits your risk, and there's lower fees compared to the mutual funds. And what I mean by lower fees is that with mutual funds, or rather even with ETFs, there's a certain percentage of the returns of the individual stocks that get taken up by management fees, like what the people who are running the ETF, they take that as their cut. With ETFs, they tend to be lower, and with mutual funds, the management fee tends to be much higher, and that really cuts into your growth over time. Now, the disadvantages of an ETF compared to at least individual stocks is that the growth is slower, and it can be slowed down by individual stocks that are lagging, while the growth ones are still moving ahead. So sometimes people question, why don't I just invest in the biggest player of that sector, which is a fair discussion, but that comes with risks. So I list some examples of ETFs here. So VGRO, which is a very popular one, And it's popular because it's as diversified as you can get. It's like it's the Vanguard, but it's also other ETFs from other countries and other regions of the world. So it's very diversified. Another one is the VFB, which is I already mentioned. That's 𝗥𝗲𝗃𝗃, which is the NASDAQ, and that tends to be very tech heavy. So it's similar to the Vanguard, but you see these numbers as being almost double, right? So it's very tech heavy, but it also grows a lot faster than VFB and VGRO because of that, or at least historically because tech stocks have been doing so well. But previous growth doesn't really predict future growth. And then you have a very specialty type of ETFs, which and I gave one example is LBS. LBS is something I invest in, and that's just an ETF of all the North American banks. Next, in terms of basic terminology, when you're on the trading platform, so this is a little bit more closer to the actual thing. You see like a platform and information that's listed like this. Last price means the price at which the last trade cleared, that's the price at which the last stock was sold. Ask is what people who are trying to sell the stock are asking for, right? Bid is what people are offering, right? You see here size. So that means, and size is actually multiplied by 100. So that's it refers to 1 unit. So that means there's a demand for 4,800 stock of this stock at this price. So it gives you an indication of something called momentum, which direction a stock is going. When you see the ask is low, but the bid is high, that means there's a demand and the stock is likely, at least in that moment, going to skew forwards. Next is how do you actually go about buying, right? So there's different ways of buying a stock. You could put in something called a market order or something called a limit order. Personally, I avoid market orders because you don't know the price you're going to get. It just clears, and it clears at whatever price the asking price is. So you may get a price that's wildly different from the price that you wanted to buy it at. Limit buy means this is the price that you are comfortable with, and this is the price it will clear. But the disadvantage is you may not get that stock then, right? So that's the main disadvantage. And sometimes you need to move up your limit buy. And one safe way to do it is to see the asking price and put 1 cent above the asking price, right? And that way it'll clear immediately, but it won't clear at a ridiculously high value more than you wanted to. And then there's something called a stop loss. And this is basically a fail safe for when your stock automatically sells. Suppose the market is crashing and at this price, your stock would automatically sell before it falls below. There are some nuances with that. I personally don't set too many stop losses just because, actually I won't get into the details of that right now. That's more nuanced. So now in terms of general rules of investing, first is I only invest in good companies that I believe in. So and I don't invest more than I'm willing to lose. So one rule of thumb is if I'm going to invest in something, I put in at least at this stage of investing, I see it, for those who play poker, I see it as a little blind and a big blind, right? If I'm confident in a company, but you don't know if the price is going to drop a little bit, I put 500. If I think the company is definitely at a good price, then I put 1,000, right? So you guys sort of set yourself investing rules and live by them, and because you have to be sort of structured. Next, focus on the big picture, right? Ignore the short-term fluctuations. Like right now, the tech stocks are not doing very well, and they've been falling for the last week or two, right? So this is a short-term fluctuation, right? And a lot of people who believe in certain companies, they're taking this time to invest right now to buy up these stocks while they're cheaper. Next, don't succumb to FOMO. All right, so a lot of people see something like GameStop, which is in the news a lot, and they're like, oh my God, the stock is going crazy. I need to buy now or I'm going to miss this opportunity. and then they buy in, and then the stock falls, and then they're stuck holding the stock. So keep in mind, there will always be more opportunities. On a given day, there's so many stocks that are at a good value, and so many stocks that are overpriced. So you want to look for, like, if you see a stock and it's flown and it still is growing so rapidly, don't fall for like missing out. Just look for another opportunity and maybe wait for that stock to come back down. Next, it's okay to gradually claim profits as your stock grows up, right? And it doesn't. And one strategy, if you're in, this is only for really individual stocks or for more regional ETFs, is selling. For example, when your price doubles, like suppose you buy $1,000 in one stock and it gets you 2,000 in a year or so. If you want, you can withdraw your initial investment and leave the rest to ride. And then you can reinvest that $1,000 or whatever that you got. So it's okay to claim profits gradually and develop like a reserve. And then diversify. And the advantage of diversifying is so you don't panic when certain sectors get hit. So that's it for investing. Next is a big question that's on a lot of people's minds is renting versus owning. The disclaimer being a lot of this just applies to Toronto markets and I guess the GTA. So this is sort of the price growth since 2000 in condos. And again, past growth doesn't really predict future growth. We may be peaking. It's really hard to predict. You see all sorts of predictions always put out every day, and really no one knows what's going to happen. But this is the data. The data shows prices have been increasing, and they've been steadily increasing. And right now, the average price of a condo is about $637,000. It's up quite a bit. And the average, so right now, for example, the prices for rent have come down. So the average rent right now for a 1-bedroom is $1,800, right? So over an 8-year on average for to do an MD PhD, if you got a deal at $1,800 or paying around $1,800, it adds up to $172,000 that you just spent on renting that you'll never get back. That money is gone. Okay. Sorry, I have some construction going on in my house, and the doors have actually been taken off because they're being painted. Okay, so where I left off, in terms of considerations for buying, average price of a condo right now, as I said, is $640, and you need at least a 10 to 20% for a down payment. So you're looking at between $64,000 and $128,000 for a down payment, which is quite a bit of money. And then on top of that, there's closing costs of between $5,000 and $10,000, and sometimes a little bit more, right? Depending on how expensive a property. So there's a lot of money involved to just get into the market. And then you need to consider things like cash flow, right? So if your mortgage for $640 at today's interest rate, it would be around $2,350. So that's already a lot more than what you'd be paying for rent. And then you got to consider something like property tax. You got to consider condo fees, which on average is about $450. Some buildings are older buildings are a lot higher. Some buildings are a bit lower. But the thing you need to keep in mind is you might be attracted to a very low condo fee because it's a new building, but then over time that condo fee will rise a lot faster and meet the average. It's just because it's a new building, and after a certain amount of years, like at the beginning, a developer subsidizes the condo fees to keep it artificially low, but after a certain amount of years, that artificial subsidy releases, and then the condo fees start rising a little bit faster. So something to keep in mind. And then finally, you got to also think about insurance, utilities, etc. So you can look for a $640,000 condo. You're looking at, I guess, a carrying cost of $3,200, which is a lot of money, especially for a student, especially if you're carrying it all on your own and you don't have a partner to split that with. The pro is for owning is that you get to build equity every month. And that's equity that you can reclaim. So of that $2,350, right? at today's interest rate, more than half of it is actually equity. So it's money that's actually being deposited, and you could actually later withdraw, or when you sell your condo, you'll get that money back. And then there's also the assumption of appreciation over the long term. The con being obviously being the high upfront cost, the cost of property management, the large impact on your cash flow, and your assets. It's an illiquid asset, so meaning you can't just wake up one day and sell your condo like you would sell a stock. In terms of renting, the pro of renting is that you can take that money that you would have put it into a condo for a down payment and invested that money over time. It gives you a lot more flexibility. It carries less responsibility, and also allows you to preserve your cash flow. The con being that it's a big sunk cost, right? Like in terms of your rent, you'll never get that money back. And then also you have to consider that you'll be dealing with a landlord, which may increase your rent from time to time. Now, in terms of rent, as I said, it's about $1,800 in Toronto. But when you consider equity, of that $2,358, your interest cost is only $816 at least today's interest rate. So at the end of the day, if you were to look at sunk costs are actually less than your rent, because once you subtract, because you can't count equity, so you're actually saving a little bit more money in a weird sense. Although it's hard to keep, it's hard to conceptualize that initially because you don't consider equity. Next is like a sort of an analysis, right? Like how would this look? So putting together rent versus buy, this is a hypothetical situation, right? Assuming a 4% annual growth in your condo, averaged over 5 years. So some years your condo prices may actually go down, right? But in some years it may be a lot more than 4%, which is hard to predict. But assuming a 4% price growth, your cost of buying is about $24,000 versus your cost of renting is about $113,000. And this is, again, only assuming a 4% growth. It may be a lot higher than that. And the few assumptions is that you take a mortgage that's spaced over 25 years and your interest rate is only 1.7%. Now, this scenario, though, only considers that you don't do any investing. So that money that you could have otherwise put into investments, you didn't do anything with it. You just held on to it, right? So now let's look at what happens if you were to take, if suppose hypothetically you have that money to invest, that down payment, and then you contributed your savings. Because as I mentioned before, your carrying cost of the condo is $3,200, and while your carrying cost of the condo is about $1,800, right? So you're saving about $1,400. What if you were to hypothetically contribute that $1,400 every month into investments? This is, again, a very hypothetical situation. And then if you look at the average growth of the index funds, which is around 10%, at the end of, say, a 5-year period, that would amount to $215,000, right? So in which you have full flexibility over. Now, looking at all this, sorry, my voice is a little dry because I've been talking all day. But in terms of summarizing all this, assuming you were to invest your initial your down payment, right? The rental summary, you can end up on top of about $102,000 after 5 years. While if you were to buy, you end up with about $136,000, assuming you only have 4% growth. So what this means is there's hope. You don't necessarily need to rush out and go buy something. You can actually get similar returns from just investing and investing very cautiously as well. You don't necessarily need to go rush off and buy an apartment, although there's some caveats to this, right? The caveats being we are humans and we react emotionally. With stock investing, as I mentioned before, you can emotionally react, and when the stock market dips, right, and sometimes it can dip like 10-15%, a lot of people may react emotionally in that moment and sell, and wiping out a year or two worth of savings in that just few moments, right? Only to see that the stock market has recovered 2 months later back to what the price that they had originally. With a condo, that doesn't happen as quickly. You can't panic sell a condo. Well, I mean, you can, but it's much harder to do. And generally people will try to talk you out of it. So are condos a good investment? So this is my opinion. So one is, yeah, you gain equity, a little bit of equity every month. You benefit from some modest appreciation. If you get a 2-bedroom condo, which is even more expensive, you can reduce your cost by having a roommate, all right? And then it's just easier to maintain compared to a house. The caveats being that in terms of supply and demand, they're constantly building new condos, right? So there's always this question that's been going on for years. Is supply going to eventually outstrip demand, and are we going to end up with excess condos? And if that's the case, we may not see that 4% appreciation every year. And then also condo fees are sort of outside of your control, and they may arbitrarily increase over time. And then there's a very sensitive topic. Should you leverage your 𝗧cie as an MD PhD student? So this is, again, a hypothetical situation, not something I would say you should do. But hypothetically speaking, right, if you were to take $75,000, right, hypothetically speaking, and right, today's interest rate, I believe for 𝗧cie is 2.25. But let's say I bump it up to just 3%, which is more higher than it is right now. Over 5 years, the interest that you would pay on that $75,000 would amount to $12,000 is the interest that you would pay. So that's something to consider. Is not as dramatic as a lot of people would think, just because the interest rates are so low. And with that 75,000, if you were to go back a few slides, you can imagine how much growth you can get. But that's, again, a very risky investment. So the con of investing your 𝗧cie is that it's very risky. It's against conventional advice. You need to be comfortable with that risk. And of course, you don't necessarily need to invest 75,000. It could just be 5,000, as I mentioned before, and consider that as your tuition to learn investing, right? Interest rates will realistically increase over time, and that's why I use 3% as my assumption right here, not the 2.25, which is very low. Then you also need to be comfortable with multiple sources of debt, right? A lot of you probably have 𝗧sapp, you may have other sources of debt, and then you have this 𝗧cie on top of it. And lastly, once you become or at least with 𝗧cie debt, you need to be comfortable with making monthly interest payments, right? Which adds to your that cash flow equation. And in general, it's not recommended to withdraw a large amount from your 𝗧cie if you already carry a significant amount of debt and have little cash flow. So for regular medical students who don't have a lot of cash flow, this would be a very risky thing to do. So again, coming back to the argument from before, $5,000, right, over say over the same period of time, it can be quite a bit if you contribute gradually and do it in a responsible way. In that time, for example, if you took that $5,000, the interest on that $5,000 over 8 years is actually just $1,300. But look what you could actually do with that money if you invest and this is without taking any major risk. This is just $5,000 and then putting $200 from your savings into it monthly. And again, this is a hypothetical situation based on previous performance. So lastly, I'd like to end with some resource recommendations. So these are some books that I found really helpful for me, at least when I got started. This is a book that I read like a decade ago that got me started on investing. And it's really more about the mindset. It doesn't really teach you anything that useful other than just getting you into that investing mindset. And then the other books, again, more about the mindset and not about the actual day-to-day. The only one that's actually focusing on stock trading basics is this one, the Canadian Stock Investing for Dummies, and I have it in my on my bookshelf. And I occasionally refer to it, but not so much anymore. And then things that you can find useful. There's like the rent to own calculator that I used was on 𝗧cie𝗃𝗲𝗿𝗲𝗱. I think there was actually another website that I used. I can share that afterwards. I use 𝗧cie𝗽𝗃𝗲𝗃𝗃 as an app to look at for houses and look at condos. It's really helpful to look at sold prices to see how things are selling right now and not just looking at the listing price, which is very misleading. For basic terminology, I use Investopedia, which really explains things very well. And if you're looking for like a YouTube channel for someone to like explain everything like step by step, I found this one pretty helpful, Brandon Davis Investing. So now I'll open things up for questions.
There you go. I think what the email address you sent me, it may have a typo. Is it mail.toronto.ca or is it mail.utoronto?
Mail.utoronto.ca.
Oh, it should be utoronto.ca, right?
Yeah.
Okay. So I know that some of you guys sent us some questions and through the Google surveys. So I'll read out some of the questions, and I think some of them we've actually covered in the lecture itself. All right, so let me pull up the first one. Someone asked what to invest in / how to pick brackets stocks or mutual funds.
So first off, I would never put money in mutual funds. I've had terrible experiences with mutual funds, and they don't grow and they have high management fees. I'm not a fan of mutual funds. ETFs, I'm a fan of, and individual stocks if you know what you're doing. And so how you go about picking like I guess an ETF or is go with what, like I guess particularly what is really well diversified. I already mentioned VFV, which is just the S&P 500, right? I already mentioned like you want to pick the big ETFs that a lot of other people invest in that have really large funds. So the reason why you want to look at the size of the fund is if an ETF is only about say 100 million, small day-to-day fluctuations will have a big impact on them. But if they're worth like billions, if this fund has like a fund of in the billions or the 50, 100 billion range, day-to-day fluctuations won't have that much of an impact. So even on a bad day when the entire market is red, right, it'll only maybe go down 1% or 2%, right? And that means it's not as dramatically affected by day-to-day fluctuations. And a 2% decline in that is considered a big deal. Well, if you look at individual stocks, those stocks may have gone down like 10% or 20% in that same day. How do you pick individual stocks? That's like a topic of of an entire other presentation. But generally pick stocks that you feel comfortable with, that you feel that you believe in, and that are going somewhere, right? Like, and for example, if you really believe in Tesla and you think it's doing great things, and you would invest in Tesla, for example. Right? I'm not to say that you invest in Tesla, but you invest in companies that you believe in that have a good track record and have a future. And don't just invest in things for the sake of like FOMO, like GameStop.
Yeah, and because like neither Ayan or myself are, certified financial planners, or nor do we have like CFAs, for example, we're not necessarily here to kind of teach you how to pick stocks. We're not here to teach you like what exactly to invest in. One other resource that I might recommend is just to kind of gauge your risk adversity. So some of these companies like Vanguard or Vanguard iShares, like a lot of those companies will have things like investor questionnaires. So if you just Googled, say any company, like for example, Vanguard investor questionnaire, even robo-advisors have it as well. And you just do an investor questionnaire, it'll kind of tell you what type of breakdown stocks versus bonds your portfolio is recommended to be. And a lot of the financial advisors that you meet with will kind of go through this kind of stuff with you as well. All right, so the other thing that Sachin wanted to write in the comments, also, if investing in an ETF, you should also be thinking long-term / big picture. These aren't funds that are susceptible to huge fluctuations. And even if it's down 1 to 2% from a given dip, the goal is to buy and hold. So that's a good point as well. That's another tip that we mentioned in those 5 tips as well. So the second question, it's a little bit of a longer question, so I'll break it up in chunks. So the person who asked it asks, I would like some explanations with the business / financial structure of medical practice in Ontario / Canada. For example, I believe Family Doctors in the community operates almost like a small business, primarily by charging OHIP. Since MD PhDs tend to be more academic, what is the business structure / pay structure of being an internist, surgeon, oncologist, radiologist, etc., i.e. different specialties at an academic hospital? So that's the first part of your question. So I'll try to address that. So if you're working in an academic center, it kind of varies based on the academic center. So for example, if you choose to do PEDS and you work as an academic clinician at 𝗧cie𝗃𝗃𝗿𝗏, it might be paid by a salaried model. Whereas, for example, if you choose to work at, say, Sunnybrook, where I'm from, it may not necessarily be. It might be in a form known as alternative payment plan. And this kind of model might come with, you can bill OHIP for the clinical stuff you see, but you might also get a stipend, which is kind of like a semi-salary or a grant for you to do research, for instance. Other hospitals might have billing groups. So for example, let's say if you're part of a group and that entire group bills OHIP through one billing number. And so that way, there might be some people in the group who might be doing full-time clinical work, which pays more, and other people in the group who might do half of the time clinical work and half of the time doing research. So you want to be able to value that second person who does half-time clinical, half-time research, because they're adding a lot of value to the team as well. So you want to make sure that they're sufficiently paid. So all of the billings of that whole group might be pooled and then divided up equally, for instance, to accommodate for the time spent that individual spent doing research. The second part of this person's question is, what are the financial differences and considerations of practicing in the community and in an academic hospital, and potentially differences for 100% clinicians versus clinician scientists? So I'm going to screen share because I do address this question in a video. So this particular video here, which I did for Queen's University, it's called How Do Doctors Get Paid? Intro to Physician Payment Models. So I do cover a lot of those questions that you ask about the different payment types, as well as the difference in practicing from academic versus community too. And for the third part of that person's question, so that person asked several questions here. Let me just pull that up. So the third part of that question is, I would like to own a practice. Instead of starting a brand new practice, some doctors have mentioned the possibility of buying an existing practice, presumably from near retirement doctors. Assuming finance is not an issue, do you think this is a reasonable approach to starting a practice? Is it very rare to find such sales? And if opportunity arises, should the purchase be done in residency? So this is a question about, once you finish residency, should you buy up a practice or start your own practice? Most people, when they graduate residency, they don't necessarily buy a practice or start a practice from scratch. Reason being is that, for instance, if you're starting your own company, for example, and you don't know anything about how that industry is run, how people in that company, like how that industry works, would you still do it? No, right? That's a very high risk way of losing all of your money. So a lot of residents, when they graduate, will locum and they'll try out many different practice models, like depending on like many different types, academic, community, etc. And they'll pick and choose and see how some practices are run, what works in one practice, what works in a different practice, and depending on what specialty you are in, or what area you want to practice in, rural versus city, you kind of pick and choose and you learn from seasoned clinicians what works and what doesn't. And when you have that kind of these skills, when you know how to bill, when you know what are good EMRs and what are bad EMRs to use, that is when you are equipped with the knowledge of potentially starting your own practice. So to answer your question in summary, no, a lot of new grad do not buy up their own practice and they do not do the purchase in residency. One resource I want to share a screen with you to whomever asked that question is the OMA, Starting Your Practice Guidelines. So I'll just kind of share a screen briefly so you just know what it looks like. So, and I'll post the link after I show you this in the chat. So you guys have that and you can bookmark it. So this is the Starting a Practice Guide for new physicians. And you can basically kind of see like, deciding how and where to practice, what factors to consider in selecting your practice, how do you approach at least. And so you'll see a lot of these kind of things as well. And as well, a timeline on opening a practice. What should you do 1 to 2 years before and so on. So there's a lot to consider when it comes to starting your own practice. And those are some of the resources there. I do encourage you to see if you can partner up with someone who is more seasoned, who has that kind of years of experience if you are thinking of starting something. Someone made a comment in the chat, which is not sure if this has been mentioned before, but capital gain on primary residence is tax-free, while capital gain on equity is 50% taxable. So that's a good point. And Ayan, if you wanted to talk about this as well, we do actually, I think we do include that in one of the calculations with the buy versus rent chart, right?
Yeah, so with all this is in a TFSA, so you wouldn't be taxed on it, even if you take it out. So hypothetically, even if you were to turn that, say, $5,000 into $20,000 and withdraw that $20,000, you're using post-tax money, and this is all within a tax-free savings account. So that was, the account was designed for this, so you wouldn't be taxed capital gains on that TFSA. Now, if you were to do this within a corporation and do it as a business, that'd be very different, and you would be taxed capital gains in that situation. And if you do it in an RRSP, then you withdraw, then you'll be taxed as income. But because this is using I guess post-tax money, and it's within it's sheltered within a TFSA, you actually don't have to pay capital gains.
Great. So somebody also asked earlier, what is a reasonable MER for ETFs/mutual funds? And
yeah, on that note, so you see a lot of these larger like Vanguard ETFs, they have MERs of like that are very low, like 0.11, which is considered very, very low. And I think anything less than 0.5 or 0.4 is very good. But then you have some niche ETFs which are very actively managed, which have higher MERs. And those are like 0.75, and also that's a little bit on the higher side, but not dramatically high compared to mutual funds, which sometimes have MERs of like 1 or 2%, which really take away from the profits that you can make. So I remember with MD, I remember in the past that I had a few mutual funds, and they, in the same time that I had my index fund, grew maybe 5 or 4% in 2 or 3 years. Meanwhile, my ETFs had like grown far more than that, and it made me wonder, like, how am I losing on this, right? So that's pretty much convinced me never to do mutual funds again.
I would agree, because some, like my parents didn't know, so they invested in mutual funds, and they ended up, when I looked at what mutual funds they were invested in, it was like 2.66% MER. And this this commission gets paid regardless of whether the mutual fund makes money or not. So just to kind of like break it down for you, so stocks, the only thing you're paying is that fee of like $4.95 to $9.99 of purchasing the stock. Afterwards, you don't really pay a percentage of like each year of owning the stock. Then you have like ETFs, for example, that are DIY, that you're doing it yourself. Then you might have robo-advisors, which generally are in like the 0.5%. And then maybe you might have like actively managed mutual funds at 1% to 3% in that range. So hopefully that breaks it down for you. Okay, so the next question is about, can you talk about residency salary and RRSP investing? Does hospital match contributions? If so, a good idea for first home buyers plan?
So residency programs do not match your contributions at all. And investing in an RRSP is probably not necessary because we have a lot of educational credits. So you won't be really paying much tax in for many years of your residency.
I think what that person might be asking is if they like invest, let's say if they graduate residency or they want to buy a house. So then they might invest in their RRSP to have that 35 grand that they can take out for the first-time home buyers plan.
Yeah, I think for the whole first-time home buyers plan, it caps out at a certain amount. And then you also have to pay that money back later. So it's not just like you take it out. It's sort of factored into your future tax calculations. So as opposed to as a TFSA, if you were to have that money in the TFSA and withdraw it later, you would not have to worry about any ramifications or consequences from that. So even with the first-time buyer credit, they take that amount and factor it into your future tax income filings.
Okay, so the next question is post-residency. Do clinician scientist positions or other hospital positions match RRSP contributions?
That I'm not sure. So in most hospitals, physicians are considered not as employees, but as subcontractors. But for clinician scientists, I know at least a portion of their salaries will be as a stipend, but even that may be paid as a contractor. So in which case, there are no matched RRSP contributions, but there are some exceptions, right? So for certain positions, they may have that. So for example, if you're at Ontario Shores and a psychiatrist at Ontario Shores, you will get your salary and they also have a pension because you're an employee at Ontario Shores, and there's a few other psychiatric hospitals. Again, there's so much variability here, so I can't really apply whether they'll match RRSP contributions or not. But generally speaking, physicians are seen as not as employees and as contractors.
Yeah, and also it's like a lot of the RRSP matching programs tend to be more in the corporate world, I find. So for example, if you do decide to go into industry as a clinician scientist, perhaps you can take advantage of those RRSP matching. But at least in my hospital, from what I understand, I'm considered not exactly an employee, but a contractor, as Ayan said. So I actually don't get those RRSP matching programs either. So the next question is, what are some good, reliable sources of information for stock market investing, like for research on an ongoing basis?
Yeah, so I carry the app for Yahoo Finance. Yahoo Finance is actually great, and it's very organized and really embedded into your Android phones and iPhones, and the information comes out very clean and very easy to track. There's also like more, I guess, more niche or more technical resources like Finding Alpha, which can be useful for some people. And there's also like the Motley Fool, but I don't really follow the Motley Fool that closely for my own reasons.
Yeah, I personally use Finding Alpha, or I think it's Seeking Alpha actually, not Finding Alpha.
Seeking Alpha.
It's Seeking Alpha, yeah. So I use that as well. And sometimes what I like to do is when you're looking up a stock that you're considering investing in, search up that stock's fact sheet. So the fact sheet will tell you that particular stock's holdings, or like, for example, an ETF, it'll tell you the ETF's holdings, top 10 holdings, and the percent that it's allocated to. And then it'll also tell you the performance. And sometimes when you do invest in a stock, they'll send shareholders reports. So you can even read up on that to see like what the direction of the company is going in the future as well. Some stocks might even hold shareholder meetings too. And so those are some things that you can also attend to like see if that's a particular stock you want to invest in. I don't use Yahoo Finance, but I know that it's also a good resource. I literally just used my Apple Stocks app and they'll update it with the information as well.
Yeah, Apple stocks is really well embedded, but I feel like Yahoo Finance just has a lot more fine detail to it.
Yeah. Okay. And I know someone did say in the chat, Wall Street Bets. It's questionable. I wouldn't say that it's like, it's not exactly the, because it's like just your regular people sending advice.
That was totally a joke.
Oh, it was just scrolling the chat. Okay, I just wanted to make sure in case people like took it seriously. But the other thing is, if some of you guys are investing through your bank, for instance, some banks have actually came out with ratings, like stock ratings. So if you search up a particular stock through your bank's investing brokerage, then it'll actually come up with ratings from various different advisors, like not just from that bank, but also from say like Morgan Stanley or some other like advising firms, like investment banking firms that will rate certain stocks too. So if you search up like stock rating or even ask your bank about that, that's actually, I just discovered that recently. It was pretty useful. All right, somebody asked, may have missed this, but do banks offer med students / residents specific mortgage rates / plans that are better than usual? Yeah, do you want to take this first and then I'll ask?
Yes, but you to talk to the right person. You to talk to like people who work exclusively with healthcare professionals, and they have dedicated rates for them.
And just be very careful, because when I was getting a mortgage, like even in residency, they will like offer you like $1 million mortgages, even though your income is like 50 to 60K as a first year resident. So you will notice that a lot of banks will offer you huge sums of money, knowing that you're going to be a doctor, you can pay it back. But just because you have access to that money does not necessarily mean you can afford a $1 million house on a 60 grand salary. So I try to like hammer this down in a lot of my social media. And if you want some more information on that as well, on my YouTube channel, there's also a video that was done by Preet Banerjee, who's also a financial advisor and a financial expert, who kind of talks a little bit about this as well.
Mm-hmm.
And then,
yeah, so it really comes down to your cash flow analysis, right? Like you need to be able to afford the monthly payments, and as well as not be house poor, right? Like
exactly.
At the end of the day, you need to be able to balance the sheets and be comfortable and not always worrying about whether you can pay the mortgage.
Then, okay, so the next question is, a lot of Canadian investing advice I found revolves around using a TFSA. I was wondering what advice you might have around investment accounts to someone with a dual Canadian-US citizenship, where a TFSA is not recognized by the IRS as a tax-sheltered account.
Yeah, that's a very niche type question. Like I'm aware that the TFSA is not considered for dual citizens. In that situation, you can always, I guess, the only other option is like the RRSP, where you can have growth, but then, yeah, it really takes away that option. So it would be the RRSP is the only other, because the TFSA doesn't count.
Yeah, and the TFSA is not, unfortunately, it's not recognized, as you mentioned, but the US does recognize the RRSP as a retirement account. This is one of those instances where I do suggest that you talk to your accountant, especially when you are filing taxes that are both US income taxes and Canadian income taxes. So whoever asked that question, you know, I would suggest you talk to your accountant about this particular scenario.
Mm-hmm.
And then someone just made a comment saying, when I applied for the line of credit as a med student, I asked for a mortgage and they just said no to me.
Yeah, I mean, applying for a mortgage on your own as a med student, because your stipend, according to most banks, they don't count it as income, right? So In my situation, my partner was working, had I guess, a real job, so that helped. And then, but also when I got my condo prices were a lot less. So things are different now. Now as a resident, what happens when you become a resident is that they use projected income, and therefore they can approve you for like larger mortgages. But again, only do what you can afford. And in my situation, in addition to my resident income, my partner is also working, so they consider both of us.
Definitely will be making this available. And I also wanted to emphasize again, and I think probably the biggest take home from all of this, and Stephanie and Anna provided a ton of information, a ton of resources, is the idea of trying to get started. I think that there's a huge activation energy, for lack of nerdy words, but people are always either kind of scared or stressed, and they don't know how to get started. And I think on top of that, when it comes to things like stocks, there's this like bit at the beginning where you're like, oh, if it's going to go down, am I in a downturn? Am I in an upturn? What should I do? The reality of it is that, like, and Ayan showed this with that first graph, start small, start with something that you can afford, put it in and let it cook. And if you just do that, if that's the most passive bit that you do, you'll be in a way better position 8 years from now when you're done your MD, PhD, or however many years when you're done. So really, take time and participate and get the ball rolling. And then as you get involved on your own time, on your own interest level, you'll start to dig into more resources, and then you'll learn kind of how to grow, or you'll just kind of stick to something very straightforward and simple, like putting in 5,000 and adding something on a monthly basis. Either of them will set you up in a very good way at the end of your MD, PhD. And it's something that I think we don't talk about enough as medical students, but has a huge impact on our future endeavors, especially because we sit in this kind of 8 to 9 year bubble where we delay future income. So look out for yourself.